We all know Nintendo as the family-friendly company that brought us iconic characters such as Mario, Link, and Pikachu. But is Nintendo a good investment? Let's find out. Hey everyone, welcome back to the channel. My name is CJ, and in this video I want to talk about the investment thesis for Nintendo. I'd like to answer the question, is Nintendo a good investment? When I'm researching a company for the first time, I try to look for the one or two most important factors that will be key to the company's success in the future. In this video, I'll discuss the main levers of the investment thesis, some other bets within the company, some of the risks of the investment, and a possible way to approach valuation. Be sure to like the video and subscribe to the channel if you find this information useful. And please remember that this is not investment advice. There will be timestamps in the video description below if you want to jump around to any point in this video. Okay, with all that said, let's dig into it. The first major component of this investment thesis depends heavily on the decyclification of Nintendo's core business. Nintendo's approach to flattening the boom and bust cycle of their software and hardware business can be achieved by transitioning towards an iterative hardware approach based around a software-centric ecosystem. The old paradigm of cyclicality concerning Nintendo's earnings is quickly becoming a thing of the past. Historically, Nintendo has been a hits-driven business, whether that be for their consoles or for their games. For instance, Nintendo saw one of its greatest successes with the Wii, and that was followed by the Wii U, which by any measure was a complete failure of a console. It's actually one of the worst selling Nintendo consoles of all time. On top of that, every 5 or 6 years, Nintendo would release a new console. Every half decade, Nintendo was forcing their customers to ask the question, should I buy the new Nintendo console or not? Nintendo's most valuable asset is their installed console user base. And every 5 years, they would need to recapture every single one of those customers. Every console they released started with a user base of 0. So with an unpredictable revenue model based on a hit or miss of a console or a game release, coupled with having to start from square one with each new console release, it's easy to see why investors might be afraid to invest in Nintendo. But all that describes the old Nintendo. Nintendo is on track to flatten this cyclical earnings trend. Their most recent console, the Nintendo Switch, which was released in early 2017, is a piece of hardware that should last indefinitely. Now, instead of focusing on capturing new customers every 5 years, Nintendo can focus on retaining those customers that they have and growing the user base as well. One way they're trying to achieve this is through incremental hardware upgrades in a single family of consoles. To illustrate this point, it may be helpful to compare Nintendo's approach with the Switch to Apple's approach with the iPhone. The Switch has already seen some incremental hardware upgrades. In 2019, they released an upgraded version of the Switch with a new chipset that allowed for longer battery life and better performance. And then later in 2019, they released a smaller and more affordable Nintendo Switch Lite. And there are tons of rumors regarding the release of a possible Nintendo Switch Pro coming later this year that would support 4K docked gaming and even better performance. Similarly, the iPhone receives incremental upgrades every year. It's usually nothing groundbreaking, maybe a slight redesign of the body or a new camera, but at its core, the iPhone is the same product it is every year. And it's a similar incremental upgrade system with the operating systems. iOS at its core always stays the same. There may be new features and new designs, but at its core, it's an operating system that is pretty much consistent with what it has been in the past. Old apps still run on the newer phones, but the increased power of each incremental upgrade on the new phones unlocks new apps, games, and features like augmented reality. Also, let's not forget about the all-important ecosystem of the native iPhone apps such as Messages. For the Switch, it's pretty much the same way. Older games are still going to work on the newer consoles, and newer consoles will still be able to communicate with the older consoles. It's just that these newer consoles will unlock more power, more performance, and more features. I should still be able to play Super Smash Bros. On my original Switch, even if the other person is playing on a Switch Pro. It's about creating a singular ecosystem regardless of the specific hardware or software. Nintendo actually has a past history of iterative hardware with the Game Boy. Remember this big guy? Nintendo transformed this revolutionary yet massive piece of hardware into a much smaller Game Boy Pocket. Next, they iterated to the Game Boy Color, which revolutionized graphics on mobile gaming. It's not the same console, but they even released a Pro version of the Game Boy in the Game Boy Advance. That was the successor to the Game Boy that basically built on the foundations of the Game Boy's platform. The GBA even got its own incremental advancement with the GBA SP. Then we saw the DS, then the 3DS. They're all just building on each other's foundations, one after the other. Another thing to note is that the Game Boy and DS lines both were around for about 14 or 15 years, which is about triple the average amount of time that we said was typical for a console. We no longer have to wonder if Nintendo's next console is going to be considered a failure like the Wii U or the GameCube. Each new Switch is basically going to be the same console, just with slightly upgraded hardware each time. This should normalize both revenue and earnings for Nintendo. The most important implication of both incremental hardware and software upgrades is that they both work towards retaining Nintendo's most valuable asset. And it's the same for both Apple and Nintendo, which is the total number of installed active users on their systems. It's somewhere about 90% of current iPhone users will buy another iPhone when they need to upgrade, and it remains to be seen whether or not that will be the same for the Switch, but there are a lot of diehard Nintendo fans, so it may not be as high of a percentage, but I would say that we're going to get a lot of retention. The apps and games you buy for the system will stay with you forever, so that should create enough incentive for you to want to remain within the ecosystem. It's a self-reinforcing system, and we saw it with the iPhone, and we should expect to see it with the Switch as well. Okay, next let's tackle the implications of the long-term trend towards digital distribution of software and games. The most obvious benefit of increased digital consumption is higher margins for publishers. We see about 85% gross margin for digital games versus 60 to 65% margins for physical games. Ryan O'Connor believes that because of the pandemic, the transition to digital downloads has accelerated permanently. He believes that digital purchases could reach 80 to 85% of total game sales. And if that happens, earnings per share could double based simply on the transition to digital. Buying digital is a better experience for the customers, and it's a lot more profitable for the publishers. On top of the increased margins for Nintendo's digital downloads, Nintendo has another lever with downloadable content. That's another high margin revenue source that they can leverage to continue to keep players engaged with their games and the Nintendo platform. The basic game plan goes something like this. A customer buys a video game for $60. High margin DLC is released that keeps a user playing the game until a follow-up game is ready to be released. Rinse and repeat. Of course, this only works if the DLC is high quality, but let's just assume that Nintendo's long history of excellent games will keep them in the business of successful DLC. In O'Connor's report, he actually uses the analogy of the razor and razor blade business made popular by Gillette. This analogy works really well for the video game industry. The old model goes something like this. The razor, or the one-time expensive purchase for the user, was the actual console. On the other hand, the razor blades, or the low-cost, high-margin, recurring revenue source, was the video games themselves. Now we can even see games as razors themselves, with the DLC acting as the razor blades. In a sense, it's almost a fractal of itself. So no longer is Nintendo relying on the sale of one-off, major hit games like they have in the past. They're able to make a ton of revenue even after the initial game is sold. So every incremental push towards digital sales is producing pure margin for Nintendo. The transition towards digital purchases should also increase the success of Nintendo's eShop. This in turn will incentivize third-party software developers to release games for the Nintendo Switch. Going forward, this could be an important revenue source for Nintendo because, like Apple in the App Store, they take a 30% cut for every sale, even though it requires them no extra work. And just to showcase a few numbers from the recent financial reports for Nintendo, we see the digital sales for the first 3 months of the most recent fiscal year grew by over 105% year over year. Operating profit grew 98%, and net income grew over 92%. So as you can see, the more Nintendo transitions to digital sales, the higher their income's going to be. And here we can see the total breakout for digital sales for the last 3 fiscal quarters. They hit a high of about 55% digital, which is really good, and it dipped a little bit back down. What we really want is for Nintendo to strive for closer to that 80 to 85%. I think management understands the importance of this high margin, recurring revenue type of income. So I think they're going to work hard to continue to push Nintendo more into a digital download direction. Another piece of the puzzle is the Nintendo Switch Online membership. Nintendo has over 26 million Nintendo Switch Online subscribers. This service gives users access to online gameplay, cloud save, access to a library of retro games, and more. And of course, this subscription service is recurring and high margin. A 12-month Nintendo Switch Online membership costs about $20 per year, which is less than $2 per month. Compare that to a 12-month membership to PlayStation Plus, which costs about $60 a year or $5 per month. Part of the reason why PlayStation can charge more is because they actually do have a better online experience than Nintendo. Nintendo has announced that they're going to be replacing their 2-decade-old network infrastructure, which powers all their online gaming. And it's a common complaint, especially among the competitive gaming communities, that their netplay and netcode is actually just a joke. You can really tell the age of their online networks if you simply play Super Smash Bros. Online. So for now, the lower price is justified, but it also has another embedded advantage. A lower price point can potentially lead to a much higher adoption rate. As the service evolves and improves, Nintendo will have the pricing power to continually increase the subscription fees. Even now, with the lackluster online gameplay, I would still willingly pay double for my Nintendo membership. I am an active gamer, and I use the Nintendo Switch console every week. For me, $5 a month would be totally worth it just so I can play occasional games with my friends online. Think about how Netflix purposely underpriced their offering in the beginning. They slowly but surely built their user base and their content library, and you get hooked on Netflix. You can't imagine not having access to that wonderful library of movies and TV shows. And with that, they've continually increased their subscription fees. This same tactic could and should apply for Nintendo. And if they offer this catalog of ridiculously popular games for $5, $10 per month, I think that's going to be huge. That could push Nintendo's annual revenue for online subscriptions to over $1 billion, and that's just if we only have 26 million users, which is surely to grow in the future. And the subscription model is super sticky because everything you buy stays with you forever, but you can only use it to its full potential if you pay for the online membership. Again, that's a recurring, high-margin business. And a quick note on the topic of pricing power, Nintendo is the king of pricing power. Nintendo sold 8.3 million units of the game Super Mario 3D All-Stars. This was simply a collection of 3 of the best upscaled 3D Mario games. And they sold this for $60. And recently, Nintendo announced that they're going to be remastering and re-releasing The Legend of Zelda Skyward Sword, and the list price for that is $60. And that game is, I don't know, a decade old at this point. The beauty of Nintendo is that because of the quality of their games, they're able to resell those at full price even years after release. One of the top selling games is Mario Kart 8, which was actually originally released on the previous console, and that's still selling for $60. We have Legend of Zelda Breath of the Wild, Super Mario Odyssey, and Super Smash Bros. Ultimate all selling for $60. All of those games are fully priced, and the consoles are still sold out everywhere, and they are selling for full price too when they're in stock. People are happy to pay these prices to enter the Nintendo ecosystem just because these games are so great. But it's possible that this pricing strategy is intentional. If Nintendo discounted the price of their games, it would possibly diminish the quality of their IP. Plus, having such a deep and great library of games is great for Nintendo's bottom line. Not only do you have to pay full price for the games, but you have to shell out the cash for the console, which is the only console that can play these Nintendo exclusives. The price of games are almost definitely going to go up in the future, and same with the consoles, and that's only good news for Nintendo. As the flywheel for Nintendo continues to spin, software and service income should expand exponentially. There's also another factor of nostalgia working into play. I am a super fan of Nintendo, and I remember opening up my first N64 on Christmas Day when I was 6 years old. I unwrapped the cartridge for Super Mario 64, and I was just speechless and giddy with excitement. And I'm sure a lot of people my age feel this very same way about Nintendo. So the decyclification of the console cycle and the long-term trend towards digital software sales are the two main levers that will impact Nintendo's future the most. If management continues to execute well on these two fronts, then Nintendo is more than likely going to be a multi-bagger from here. Next, I'll talk about the other free options we have that are embedded within Nintendo. Some of these are more important than others, and they'll definitely play a bigger role for Nintendo in the future. Our first free option in Nintendo is their move into mobile games. For the first time in history, Nintendo is creating software for a non-Nintendo piece of hardware. I think mobile games make up about 3% of the overall business for Nintendo, so it's not hugely impactful now. But as we know, software is sticky, recurring revenue, and high margin. Management has said that one of the main goals of mobile games is for the user to have a good time and basically a good interaction with Nintendo's IP. This in turn should lead them to invest more heavily into the Nintendo ecosystem by possibly buying a Nintendo Switch and many games. If you've ever played Pokemon Go, Fire Emblem Heroes, Animal Crossing Pocket, Mario Kart Tour, or Super Mario Run, then you've played a Nintendo mobile game. I would think of these mobile games for Nintendo as a way to introduce new users to the Nintendo ecosystem and platform. Nintendo is really making the right choice by expanding into this $50 billion mobile gaming industry. They're effectively increasing their opportunity to convince someone to join the Nintendo ecosystem by 100-fold. These games aren't hugely profitable, as they pale in comparison to the traditional console and gaming revenue, but the market seems to be completely ignoring the upside of this segment here. The great thing about mobile games is that it costs a fraction of what it takes to develop a traditional console game. Also, these mobile games give Nintendo the optionality to offer a freemium model. Now, freemium is when you offer the base game for free, but then offer additional characters, skins, abilities, etc. for additional money. That's been hugely successful for Fire Emblem Heroes, and I think it'll be really impactful for the future games that they develop. The mobile segment's revenue is reaching about $1 billion per year, and it's just getting started. So yes, the profitability from these mobile games is certainly going to increase, especially as they leverage more and more of their IP. Maybe they release a new Donkey Kong game, a Zelda game, more Mario games, etc. But really, I think the main driving factor for these mobile games is to increase brand awareness and continue to cast their net wide to incorporate more and more users into the Nintendo ecosystem. I mean, it's worked on me. I've been a Nintendo diehard fan since I was 6 years old. And I think that'll work for a lot of people, especially as we're seeing the first generation of parents who have been gamers their whole lives starting to share Nintendo with their children. So yeah, mobile is a big opportunity, and I think it's going to play a huge factor in the future for Nintendo. And last but not least, let's talk about how Nintendo can harness their huge library of intellectual property. This is where a comparison between Disney and Nintendo really starts to make sense. If you want a one-line description of the Nintendo investment thesis, it's that Nintendo is the Disney and Apple of video games. First up, which is obviously a copy and paste from Disney, is Nintendo theme parks. We're going to be seeing a Super Nintendo World opening up in Osaka in Japan, and eventually Universal Studios around the world will be having Mario-themed rides and sections of their parks. So not only is this an opportunity for Nintendo to make money, it's another opportunity for them to immerse their customers in the Nintendo universe. Another way they can harness their IP is through television shows and movies. There's already a movie in production with the studio that brought us Despicable Me. That's going to be a Mario movie coming out, and hopefully it'll be good. You never know. It's kind of difficult with these things because a bad movie about Mario could actually tarnish their brand. So this is a little bit risky, to be honest. But obviously it could generate millions upon millions of dollars if it's a successful box office hit. And if it's a good movie, like all Disney movies are, parents are going to be watching those movies every day, and then those kids are going to have their kids watch the movies every day. It's going to be a continuous virtuous cycle for the one-time fee of producing these movies. Ryan O'Connor thinks that the revenue potential for these movies will be somewhere in the ballpark of around $2.5 to $3 billion revenue worldwide. Those targets are in line with huge blockbuster hits like Toy Story and Shrek. But recently we did see a Nintendo movie that was actually pretty good. Detective Pikachu came out starring Ryan Reynolds as Pikachu. And while it's no Citizen Kane, it's a movie that families are going to probably be watching a ton in the future. Eventually think about how Disney has performed with Disney Plus. They have their own platform dedicated to all of their content, and Nintendo could very well do the same thing in the future. So if these movies and TV shows turn out well, then we can expect this to be a gift that keeps on giving for Nintendo shareholders and the families who enjoy the movies. Finally, we have retail stores. And again, we can compare Apple here to Nintendo. Apple has had hugely successful retail stores, and when the first Nintendo store opened up in Tokyo, we saw hours-long lines even months after the store opened. So there's obviously a huge demand for Nintendo merchandise, Nintendo t-shirts, etc. And again, it's one more opportunity to steep people within the universe of Nintendo. Ryan O'Connor's report goes into a lot more depth about this scenario. We also have other pretty big options, such as Nintendo's stake in the Pokemon Company and other development companies. Nintendo has a 10% stake in the Seattle Mariners. The list goes on and on. They have so many upside opportunities. It's ridiculous. So if there's so many great upside opportunities, what are the risks of this investment? Well, to be honest, it's really hard for me to see a major downside risk. The biggest one, of course, is if Nintendo actually fails to follow through on flattening the cyclicality of their earnings. In that scenario, we'll see an eventual bust in the success of the Nintendo Switch, and the share price is likely to decline. But as it stands today, in all honesty, that scenario is highly unlikely. Nintendo's management may be contrarian, but they're not stupid. They're making all the right moves in order to position Nintendo to both increase their digital sales and decrease the volatility of their earnings. So as I see it, the biggest risk in any investment is permanent loss of capital. And as far as I can tell, it looks very unlikely with all the asymmetrical upside opportunity that we're gonna lose money. Hey, that's not investment advice, that's just the way that I see the situation right now. If Nintendo can capture or replicate even a fraction of Disney's merchandising opportunities, we're going to see a really big bump in revenue for them. We even recently saw a huge bump in Lego sales after a collaboration with Nintendo. Mario has that effect on people. Another risk is the risk of attention. Now, a large part of my psyche may have been taken up by Nintendo, but that's not necessarily true for customers going forward. There are other platforms like Minecraft and Roblox that are hugely popular, and if my friends are playing Roblox, how much time am I going to have to play Nintendo? Now, hopefully in this scenario, it's not an all or nothing type of situation, but there is a chance that, however unlikely, Nintendo could start to become irrelevant. Mario is very popular right now, but, 30 years from now, we have no idea if people are still going to be able to recognize him all across the world. Nintendo could once again fall back into obscurity and be making quirky, yet not particularly profitable hardware. but chances are good that they should avoid falling back into obscurity. A lot of efforts from mobile games to expanding their IP are really great marketing forces for keeping the Nintendo brand relevant. Okay, let's move on to the valuation. I'll quickly touch on a few ways we can go about valuing Nintendo. One way to do it is to look at a sum of the parts analysis. I think Ryan O'Connor at Crossroads Capital did an outstanding job, a better job than I'm going to do, of breaking out each individual segment and valuing that. You can check out the analysis more in depth in his report linked below, but the chart here explains his valuations for the sum of the parts. The report is a few years old at this point, but I think he's made some pretty valid and accurate predictions. Either way, we can see that the conservative valuation will have Nintendo at $97 per share, and his more reasonable assumption has it somewhere at $197 per share. Of course, these numbers have probably changed for him since the report has come out, but I think this is a pretty good place for us to start. Oh, and I want to quickly mention that Nintendo currently has $10.5 billion worth of cash on the balance sheet. Historically, because of the boom and bust of their console cycle, they needed a lot of cash on hand for just-in-case purposes. But now as they transition to a less volatile earnings pattern, they could put a lot of that cash to work, creating a lot of value for shareholders. In my opinion, the best use of that money would probably be to put it into the growth of the business. They could invest in cheaper consoles or higher quality consoles. They could continue to come up with innovative hardware and accessories for the Nintendo Switch. There's tons of stuff they could do to continually grow their business. The second best alternative would be to buy back shares. If Nintendo seems to be undervalued, then spending money buying back shares is a great way to create shareholder wealth. Nintendo could continue to hold onto that cash as a buffer, but there's one last option which I wouldn't be a fan of, which would be Nintendo paying that out to shareholders as a dividend. There's a ton of opportunity to reinvest the cash back into the business, and I think that for every dollar that they invest, they'll easily be able to create more than $1 of value. Another way we can look at this company is through a discounted cash flow approach. The crux of the thesis is that Nintendo is transitioning from a more commodity-like business where they would have very cyclical ups and downs to one of the more wonderful businesses that Warren Buffett always talks about. A business driven by high margin, low capex, recurring revenues. As we saw earlier when Apple released the iPhone, they had just incredible free cash flow growth. If Nintendo behaves anything like Apple, I think as investors we're in for a real treat. Apple grew their free cash flow at 36% from the years 2006 to 2018. My estimate is going to be a little bit more conservative than that. Let's start with a free cash flow value of $3 billion. Then let's assume that Nintendo will grow at 15% per year for the next 10 years. And then after that, it'll only grow at 3% per year. The rough intrinsic value per share would be about $116. That's about a 56% upside from the current share price of $69, and that comes out to about a 13.5% annualized return. If we get a little bit more aggressive or reasonable with our projections, things start to look a lot better. We can start with a free cash flow value of $4 billion, which is closer to what Nintendo actually produced last year. Let's assume that Nintendo grows at about 20% per year for the next 10 years, which is still 16% less than what Apple grew at. In perpetuity, let's say that Nintendo will grow for 3% per year. From that standpoint, we can see an intrinsic value per share of $230. That's close to a 20% annualized return, and that's just an incredible result no matter which way you cut it. Keep in mind that these are rough estimates. Please do your own calculations and research into this company before trying to decide upon a value. So there you have it. To answer the question that I posed in the title of this video, yes, I think Nintendo is a buy, and yes, I would be very happy to have it in my portfolio. Some might argue that it's fully priced, but I really don't think they're seeing the whole picture. Will I buy it? Now, that's another question entirely. If I'm smart, I should probably put a percentage of my portfolio in this company. However, before I make a decision, I'm still going to dig in a lot deeper and read more of the annual reports, and maybe I'll get back to you on whether or not I've invested in Nintendo. If you like this video, you may enjoy my video over here about Mohnish Pabrai's new investment philosophy. I would really appreciate it if you liked the video and subscribed to the channel if you found this helpful in any way. A lot of the research for this investment thesis came from Ryan O'Connor of Crossroads Capital. I'll have a link in the video description to his original write-up on Nintendo. It offers a lot of background about Nintendo and way more in-depth detail about the investment thesis. I leaned heavily on this report in my research. Thank you so much for watching, and I will see you next time.